Welcome to This Week in Money. I'm Jim Goddard. Our guest is David Morgan, editor and founder of the Morgan Report. Welcome to This Week in Money, David.
Jim, good to be with you. Thanks.
Precious metals are finally making a move. What's going to happen there?
Yes, they've certainly made their moves. I'll be speaking at the Vancouver Resource Show here actually this weekend coming up. And what's going to happen in the metals? Well, the bottoms, I think, have been found late last year. Silver actually hit, I think, 14.15 intraday. Certainly you couldn't buy it for that unless you're in the futures market and happen to be lucky to pick up a contract or two. Regardless, we were up today as we're doing this interview, Jim, almost $1. Silver's up 86 cents on the close, up 5%. Gold is well off the 12.25 breakout level, closed up again today at about 12.80. So looks like the metals are certainly getting a nice lift into the new year. Silver was lagging gold. It may catch up here soon. The gold moving averages are above the 200-day and 50-day. Silver is approaching the 200-day moving average and looking pretty strong here. How much longer this rally will continue is to be determined, but there are a lot of fundamental background factors that are very important and supportive of the metals prices, not only here but at higher levels as well. So lots to talk about in the metals. I don't want to get too overly enthusiastic with some pretty good-sized moves already, but certainly they're both very, very undervalued relative to where they could be basis, not only their fundamental value, but what their purchasing power is relative to their historic means and what's going on in the global geopolitical war / uncertainty factors. So there's a lot fundamentally and technically supporting the metals to move higher from here. And I think 2015 is going to be a year where the metals are up year over year rather than down year over year.
Sure. I mean, we're taking a look at the currency markets with the Swiss franc up 17% in just 2 days because Switzerland has decided it is not going to support the euro anymore. People are flocking to put their money into Germany because they suspect Germany will bail from the euro and go back to the Deutschmark. With things like that happening, do precious metals become more precious and more valuable in a number of ways?
Absolutely. Gold is probably the ultimate currency. And with the uncertainty with what's going on with, the oil price level, what that's done to major oil producers like Russia and Venezuela, what's happened with the Russian currency and now with the Swiss currency, what the potential is for the euro. There's a lot going on in the currency markets, and one of the ideas that have been batted around by most of us that are, Austrian school oriented or at least more open to why gold and silver are important in the financial realm have talked about a currency crisis or a currency war. Jim Rickards has a book called Currency Wars. And we have seen, I think, the beginning of it in a big way when you get, one of the G7 involved, which is Russia, and now with Switzerland, although Switzerland is relatively small in size and relatively small GDP, it's known for its banking acumen. And when it decides it can no longer peg the Swiss franc at 120 to the euro, and that happened, I think it was 30% at one point during the day yesterday when they unpegged. So a lot going on, and this portends other problems. I mean, for example, as you said, Jim, if you saw Germany go back to the mark, or perhaps Greece bails from the euro, or the unraveling continues, let's say, I think it will spill over. And what's interesting is to note that gold is going up vis-a-vis all currencies, including the dollar now. So what that shows is that from the establishment point of view, that the gold and the dollar are, always move opposite. Of course, that's not true. We know it's not true. But what it suggests is that the safety level of the dollar is being questioned by people moving into gold. So if you see gold moving up as the dollar is moving up, which we are witnessing, that is a clear indicator that the safest place to be is the gold market, not in any currency.
And of course, people have derided the actions of central banks around the world for supporting equities to the degree that they have, with billions and billions of dollars put into it. And as so many experts have told us, all you've done is delay the inevitable. You can't support the markets forever. And I've heard that they've been the most manipulated markets in history because of that. You're not really seeing a true picture.
That's right. I mean, it's hard to say where they've done the most manipulation. I'd probably argue interest rates, because that, from the interest rates or the price of money, then everything stems. But regardless, the point being that all these markets are pretty much manipulated and controlled. And because of that, you don't get a true picture. And to back you up on what you said, I mean, the stock market or the equities market is really supposed to reflect the physical economy. So if you look at an individual case-by-case, company-by-company, you might get an accurate picture of, how that company is doing relative to what it's doing, in the real economy. For example, you might have some type of 3D printing company, for example, that isn't overvalued. They probably are. I don't study that real closely. But it's selling, close to what it should be based on cash flow and its earnings and its future growth potential and all that. But that'd be like a case, and there's more than that, just single case. But what I'm saying is the general equity market is extremely overvalued by any basis you want to measure it by. So basis looking at stock prices in a general way, it would suggest that there's never been greater times out there in the real physical economy. I mean, this is just, it's showing you, based on those metrics, things are fantastic. But if you look at the reality of what's going on, they're not. And so that's this very big discrepancy between stock valuations and the real physical economy. And it's at a point now where I think we're due to see it come down. Having said that, let me state that these markets can stay overvalued or undervalued for a lot longer than logic might dictate. I'm looking due to the oil price decline, what's going on in the currency markets, et cetera. I don't see a real huge adjustment for the situation at hand for probably, 5 months or so. I know that sounds perhaps absurd because, you can see it, but these markets have a lot of momentum, a lot of inertia, and they don't just turn on a dime because they are so big. So the oil market being one of the biggest commodity markets out there, the stock markets, et cetera. So I think it's possible that you could see overvaluations in the stock market for a few more months, and you could see, gold and silver certainly making their ways higher, but I don't expect to see a big move relative to the underlying fundamentals probably until the fall. But I could be proven wrong, and, I'm sorry, Jim, but I have to give a caveat, which I always do, and that's, of course, that's barring any, unseen, situations such as a terrorist event attack. There's some black swan out there, like Germany. I mean, Germany, withdraws from the euro as an example. I think that'd be a big enough event that it would cause, at least the disruption that the Swiss franc did when unpegging from the euro.
What are you more bullish on, silver or gold?
Right now, gold. The reason being that it's a better known, more establishment money, and it's still held by central banks. So even the bankers badmouth gold, they really, in their heart of hearts, know its value, know why it's there, and they use it. And so that's and the value. In other words, it's pretty tough to put billions of dollars into the silver market. I mean, it's such a tiny market. Whereas in the gold market, although tiny as it is, it's much, much larger than the silver market. And so that's the market that I think I'm more bullish on in the short term. And I want to emphasize short term. In the long term, I'm more bullish on silver still. So the thing to do, of course, is watch the ratio. We had a 5% move in silver today and a 1.5% move in gold. So silver outperformed at about a 2 to 3 to 1 basis, which is what I like to see to really state that the silver market is starting to catch up. But I really think one investor should own both the metals. There's different reasons why you would own one or the other, and owning them both makes sense. Also, that again, longer term, I think you'll see the gold-silver ratio come down, which favors silver over gold. But gold has more stability, is more readily accepted. So depending on your age and risk tolerance, you can favor gold over silver, or you can favor silver over gold.
Getting back to the oil market, I've heard you're very concerned about all the derivatives connected to oil and how these low prices could leave a lot of investors very vulnerable.
Well, as pointed out, is the amount of derivatives in the oil sector is about double what it was in the housing sector. So the housing sector, of course, is what's largely blamed for the financial crisis of 2008. And now we're in a situation where we have derivatives exposure that is equal to or greater than, actually greater than what it was in real estate. And oil affects everybody, just like real estate affects almost everybody. But so that's something, one, to be very aware of and concerned about. And again, there would be a delay. The housing market didn't get overvalued like, one day and all of a sudden the next day this bubble burst. I mean, they were writing these, quasi-legal mortgages for a very long time. And the same thing with the derivatives in the oil sector. I mean, the oil price just came down, but for that reality to wash through the markets where it's very apparent that these derivatives cannot be continued, in other words, that the debt payment on these loans are absolutely impossible to pay, that will probably take probably 4 or 5 months, but it's coming. And when it comes, just like in the housing derivatives problem, when it comes, it can be rather rapid decline in that sector. So I'm not saying that the oil price isn't down. That's obvious. What I'm saying is the derivatives that revolve around the oil sector, they have yet to reach the reality of what, just like the housing market, of how badly financed these situations were. I mean, they are impossible to pay in many cases. Not all, of course, but a lot. Now, at the margin, the fracking industry, pretty much as a whole, there's exceptions, of course. So big dislocations, misallocations of capital, loans that really were not justified basis anything other than an extremely high oil price. And now that high oil price is gone, they can't be justified. The market will figure that out.
Are there other derivative markets that you're concerned about?
Yeah, I think as concerned as I am about the oil derivatives, that's takes a big back seat to the major to the major derivatives issues, and that's around interest rates. Interest rates, again, the price of money, are the majority of the derivatives markets. And a lot of these are in big ways, not only bank to bank, which is pervasive, but also bank to, say, large pension funds, large hedge funds, government entities, that type of thing. So, for example, you might have a interest rate deal with a country like Argentina as an example, or, you pick one, pick a favorite. And the idea being that some of these, let's call slick type of marketers would suggest that, geez, look at interest rates are way down here. Wouldn't you like to protect yourself with these very low interest rates? And of course, that sounds good. Wouldn't you like to lock in your mortgage at a low interest rate? I mean, most people say, sure, yeah, I want to do that. So they lock in with one of these derivatives only to see interest rates move even lower. And then those investments, if you want to call them that, now don't look so good, because their bet was they were locking in a low interest rate, and they're locked in. It's a contract, and now interest rates go lower. So there's a lot of that that's gone on in the last several years. This is one of several reasons why interest rates keep getting forecast or telegraphed, might be a better word, by the central banks, especially the Federal Reserve of the United States, that we don't see interest rates going up. We have this zero interest rate policy continuing for a very long time. And this, of course, is the cardinal sin of, borrowing short and lending long. You can check Antel Fedeke's writing about that if you want to study it. But we're in a situation where I think this, the interest rates is a far bigger problem. And, of course, all the banks are interconnected. So just because you are correct, you are the one that made one of these great loans to one of these countries that, locked them into these low-term rates, low interest rates, I should say, and interest rates have gone lower, and you probably had some control over that, doesn't mean that the counterparty is able to pay you back. And that's the problem, because these debts are impossible to pay off. So since there's two sides to the story here, who's going to pay it off? Well, they've been putting it on the back of the respective taxpayer, depending on whatever country it is. It's like, well, the bank can't pay, but we certainly can make the citizens pay for the mistake, or for the bet, or for whatever you want to call it. And they're broke too, for the most part. So it's getting to the point, Jim, where I think this is the year of 2015 where a lot of this is going to come to the surface. Now, the spin that you'll get from the mainstream media, of course, is not going to be as straightforward as what I just described. There'll be all kinds of obfuscation about, what's happening and how it's taken place, and, there'll be some scapegoats and some, who knows, fun names, whatever, that come to the fore. But the reality is that you cannot maintain the financial system on a zero interest rate policy forever, even though you might hear that from very important sounding people with PhDs after their name. The truth is it won't work forever, and we're getting, I think, very close to where it's going to manifest. In fact, I think it's going to manifest, as I said, probably 5 months out from here.
David, you're one of the guest speakers at the Vancouver Resource Investment Conference. What will people hear from you?
Well, I'm going to focus on the metals, which I tend to do in those type of events. And I'm going to it's kind of a cute title, gold and silver, or precious metals, dead or alive. And I go through the fundamental and the technical work. And the answer is, of course, they're not dead. They are alive. And I go through several charts, making my point both technically and fundamentally why both these markets are far, far, far from over, and build a case of why this should be a good year, but perhaps not a great year, and why it's going to be a great year in the years ahead, meaning in 2016, 17, 18, who knows exactly. But, being a precious metals investor myself, certainly I'm looking forward to, higher prices in the metals. But in a way, I'm a bit remiss because the world at large doesn't seem to be getting better as far as resolving these problems. And that's something that concerns me, is that even though, you might be hedged or protected or that type of thing, have a safe haven, so to speak, and that's well and good. But, just because you individually or your family or whatever has a safe haven, which I encourage you to do, doesn't really protect you from a world financial system that is deteriorating more and more as this currency crisis deepens and deepens. So in a way, I'm glad to see the metals come up, but in another way, I'm a little saddened that there doesn't seem to be any real resolution to these problems. And that's unfortunate because we really need to get back on board some sound fiscal policy throughout all the sovereign nations and start working together in a way that we can trust each other. The trust is broken down, obviously, and I think we'll continue to do so. And because the trust is breaking down nation state to nation state throughout the financial system from any angle you want to look at it, currency, stocks, bonds, whatever, that trust that's broken down will be redirected into the precious metals. And that's why I think you're going to see probably one of the biggest moves to the precious metals, because it becomes the safe haven of last resort. And we may just be seeing the beginning of that may continue for the next, let's say, 3 years or so.
David, how can people subscribe to your newsletter?
It's quite easy. Just go to themorganreport.com. You can get on our free e-alert, which comes out every weekend. There's 3 levels of service that are described on the right-hand drop-down menu. You can go to our YouTube channel, which is Silver Guru, or the Twitter feed at SilverGuru22.
David, thank you very much for being on This Week in Money.
My pleasure. Thank you.
My guest has been David Morgan, editor and founder of The Morgan Report. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.